Hello. Hi everyone. Um, Today we are going to watch um, Staikov's video on market making.
So where market
Let's
okay
just
well so where market making meets market microstructure is
I hope you can hear
these
me.
are two concepts that sort of work very much hand in hand. And this is a little, the only clip art or visual that I've made myself. And, by taking these three pictures and sticking them together. But essentially, when I think of market making, I think of this job that, a market maker comes into work every day. And, the beginning of these Brownian motions might be the price of an asset at the beginning of the day. And 100 here is the end of the day. And I think of these traders or market makers doing this every day and sort of dealing with this risk. Essentially, if they're long or short, there's going to be some risk involved. And the job of a market maker is to post bids and offers in these markets to provide liquidity. And the way we thought of this model, as a building block, when we first thought of what the market making problem was, we really thought in terms of these one day of Brownian motions and how should a trader ride these Brownian motions to buy at the bid and sell at the ask. And then you'll see that in the first half of the talk, when I focus on market making, we won't put too much of a lens on this price and what it means. We'll just look at these paths and call them the mid price. And then in the second part of the talk, I'll sort of question that assumption. Like, is the mid price really a great notion of fair price? Should we be thinking of other prices? And then that's when you need to zoom in and get your hands a bit dirty and actually learn the rules of trading and how it happens with these little tick sizes and bids and offers and arrival of orders and a very kind of strange, chaotic thing that happens at the micro scale. So in a way, this talk could have been called a tale of two time scales. One time scale on the left, which is the 1 day time scale, and one time scale on the right, which is what if you zoom into the millisecond or to the second and start looking at what's happening there. So it's maybe if you're physics minded, this could be, you could think of the wave, analyzing waves from afar, and then the what, the how, and the why. Okay, so the first question: what is market making? So very soon I'll go a little bit into what it was, but the way I would like to answer the question, what is market making today, is I will say it's an algorithm that updates bids and ask quotes, and that's where I'm going to leave it at. Okay, so at the very most basic, you can think of someone turning on a computer in the morning and turning it off at night, and hopefully there's more money at the end of the day than at the beginning of the day. Now, how does that work? Okay, that's where we need to start thinking about state variables, what are optimal strategies, what exactly is happening, and ultimately how market making works. I'll break it down a little bit more later, but it's essentially knowing what the fair price is or the right price, then developing your personal version of what the right price is, and then putting a little premium, subtracting a little bit, calling that your bid, and adding a little bit and calling that your ask, and following this price around in order up. And then finally, the why market making? Well, the root need for market making is to provide liquidity. And it sounds a bit vague, provide liquidity, is that good, bad? We don't know. Well, ultimately, the way I would like to think of it is it provides immediacy to another trader that doesn't have time to stick around all day looking at a chart that's moving. Okay, so essentially we need someone, and this someone is in fact nowadays an algorithm, to be there all the time to provide the luxury for us to be able to buy and sell whenever we want. All right, so now that I've sort of defined the basics of market making, I think it's good to go a little bit into the past, and in fact into the 80s. This is Wall Street in the 1980s, and I think it's sort of fun to look at this picture because when you just see numbers on a screen, you lose the idea that this is a market, and you lose the idea that this is the interaction between many. Hong Kong Stock Exchange in the 90s. So you can see in 10 years, quite a bit has changed. There's a lot more computers per person. It might be either in Jersey or some other outskirts of the financial city. All right. So now that we've done our pictures, let me go through a little bit of that history, but in terms of the academic papers that on market making. So the paper that sort of inspired Marco and I the most was this Ho and Stahl market maker paper, which was essentially an inventory problem. And they developed, already in the 80s, a really nice framework that resembles ours quite a bit. It has some utility functions, it has some Hamilton-Jacobi-Bellman equations, and it has some really quite complicated formulas that indicate the mechanics behind a dealer. And in fact, the dealers at the time were called specialists. I think the people I was pointing at were specialists, though I'm not 100% sure. But the specialists were monopolists. So for certain stocks, only one person was the go-to person that provided a bid, and that's quite a different environment than the one that was already emerging in 2008. This idea of like electronic markets, where there's not a single person putting bids and offers, but rather a wide variety of agents putting bids and offers and competing for trades. And so another twist of that ultimately helped this paper is that we made some approximation that gave a rather intuitive formula for how this automated market maker might be programmed. And so what we see afterwards, we see this next paper here in 2012 did something quite interesting, which is it bounded the inventory. So it sort of took an even more realistic risk control, which market makers have, which is you cannot go outside of certain risk bounds. And that helped the mathematics quite a bit, and it rendered it a lot more rigorous. They were able to prove existence and uniqueness of solutions, and they were also able to show that this simplifies to a system of ODs, if not a closed form solution, something a lot easier to handle. And then we have many nice generalizations. In 2014, the incorporation of price impact and adverse selection in the market maker, and the multi-asset case in 2017. And this paper has many other twists, bells and twists. So I would say this 2017 paper by Guillaume is a great way to start really in this literature if you want to take a look. And then there's this recent case which incorporates stochastic volatility, which I'm fast forwarding a little bit to the later part of the talk, which where actually there are many open source versions of this market making code that are being used in cryptocurrencies. And in cryptocurrencies, the volatility can blow up very fast. Versions of this fast forward if you want to take a look. And then there's this recent case which incorporates stochastic volatility, which I'm fast forwarding a little bit to the later part of the talk, which where actually there are many open source versions of this market making code that are being used in cryptocurrencies. And in cryptocurrencies, the volatility can blow up very fast. And in fact, the bells and whistles that have been added to these markets, take into account the idea that volatility can be very, very bursty. All right, so market making, what's the main idea? Well, I like this meme quite a lot because I often feel like this guy whenever I talk to people about their ideas on finance, which is that, yes, if the idea doesn't boil down to I want to buy low and sell high, it's probably not a good idea. But, the devil is a little bit in the details. And I'm going to, try to provide the answer to these questions from the point of view of a market maker who naturally sets buys and sells at the same time. And therefore, by definition, the buy is lower than the sell. And the only difference here is in this meme, it seems like, you would buy low, wait a few days, and sell high. The only word that I would change here is days and change it to minutes or seconds. And essentially, that's sort of the magic idea behind market making. All right, so how do they make money? Well, I'm going to try and break it down into a few steps. First, it's this idea that you will make the bid-ask spread times the volume that you trade, at least in the best case scenario. And the other challenge is, well, you got to set your bid-ask spread around the right price. So if people are trading down here and you're setting your bids and your asks way above it, it's just not realistic. So the prices you quote need to be relative to the price that other people are trading at. And I would say that something that every market maker is keenly aware of is that they need to manage their inventory. So inventory meaning the number of shares, if it's stock, that they have. And essentially, the ideal position is to be flat. So think of a market maker as someone who can be long X and short X, but really wants to stay within these bounds and prefers being at zero. And the way the inventory is reduced is, again, by bullet point number 2, by quoting around the right price level. Okay, so in this sort of if you want to use the minimal amount of math to express the idea of a market maker, I think you would look at this kind of equations. First of all, what's the right price? My first stab at this is going to be the mid price. And then I'm going to contradict myself, in 30 minutes or so. But for the next 30 minutes, the right price to first order will be the market mid price. And then to second order, I will need to adjust my personal or my reservation price with respect to this mid price. And the way I'll do it is with minus beta Q being my inventory. So if I'm long, my personal valuation will be a bit lower because I'm desperate to sell really. And if I'm short, my personal valuation will be a bit higher than this mid price because I want to buy. So this is the main mechanism of inventory management, really. And then because this would imply that you're buying and selling at the same price, and that doesn't obey the law of buy low, sell high, market makers typically ask for a premium below and above this reservation price. So R minus delta and R plus delta. And for now, I'm not going to worry too much what beta and delta are. And really, the reason to frame this into an optimization problem is to hopefully tease out what this beta and delta should be and what should it depend on. All right, so now I'm going to step into sort of the world of optimization and specifically stochastic optimization. So something that so let's start with just a few state variables we're going to need. So the first one is just this this essentially a Brownian motion. It represents the price of the stock. And for now, we're going to think of this as the mid price. And so essentially think of these as one day of trading on a pretty volatile asset. Okay, so this is the price, but unlike most models, let's say the Black-Scholes model or other models that allow for dynamic trading, here you will not be allowed to trade at this mid price. And it's not a fixed transaction cost model, but rather it's a model where you stick your bid slightly below and your ask slightly above this mid price, and the question is by how much. And so why, what is the optimization, or what? I might need to shift this to the side a bit. Hopefully, go away. Yeah. Yes. Okay. Beautiful. All right. So the idea here, and maybe the picture is where we should start, is that this blue line is the mid price, and the orange line is the ask price, and the green one is the bid price. And so a market maker, to be noticed, needs to follow this mid price around. And the main mechanism of trading is that if you're very close to the mid price, you see a lot of trading. If you're far away, forget about it. You're not going to get any trades. So the mechanism here is that the buy orders arrive with a Poisson rival rate with intensity lambda, and this lambda depends on how far your bid is from the mid price, and it decays exponentially. So essentially, a market maker that squeezes around the bid and the ask, by let's say 1 cent, and follows it everywhere, will see a lot more trades than one that does the same at 2 cents. We'll see a lot more trades that someone does it with 3 cents, etc. So if you know a lot about order books, don't worry too much, but because this has some problems. But in terms of think of it as a market with a certain supply and a certain demand around people competing with you to supply these limit orders. It sort of does make sense that there needs to be some kind of in all optimization problems, you win some, you lose some. If you're further away from the mid, you will each make more money each time you trade, but you'll trade rarely. And if you're close to the mid, you'll trade a lot, but each time you'll make a tiny little amount. So that's the interplay. That's where the optimization will come in. All right. So what's the objective? Here we have a sort of a classic ish maximization of expected utility. So negative e to the negative gamma of this term here is just a utility function. This also reminds me of my first talk at NYU when I first arrived fresh as a fresh PhD graduate, and I had a lot to say about utility functions. And I didn't get booed off stage, but there was a lot of dislike with utility functions. And in fact, we put in a lot of effort in this paper to make the utility functions disappear. So hopefully, this doesn't throw you off too much. But think of it as a one-parameter family given by gamma, where gamma going to 0 is risk neutral, and the larger the gamma, the more risk averse you are. And this is basically just a concave increasing function. All right, but I could yeah. Yeah, so we'll see at the end when we get the results, we can just set gamma to 0 and see what we get. But essentially what you'll see is that as gamma goes to 0, the trader will not care about inventory anymore. So the risk of the price moving will be unimportant because the stock price is as likely to go up as to go down, and the market maker will not care. So yes, absolutely. Yeah. Yeah. So for example, if you quote a very tight spread, this risk will be a bit less worrisome because the other side will come quite often. But if you have very wide spread, indeed, you go long and then you may never go short again. So go back to. So what's inside of the utility function? Let's just look at this. Is essentially the wealth of the trader at time t, and we're going to think of capital T as the end of the day and little t as right now or in the middle or at the beginning or middle of the day. So the utility function here is over the cash you will have at time t, and QS is the quantity of stocks times the price. So basically the value of your the value of your inventory. So at the end of the day, all that matters is the value of what you're sitting on. So this is your P&L. It's the cash P&L plus the inventory P&L. And so the cash P&L evolves in a very simple way. So every time you sell, you add PA to your pile of cash, and every time you buy, you subtract PD from your pile of cash. And the quantity or your inventory simply goes up when you buy and it goes down when you sell. So those are basically the dynamics of X, Q, and we already saw that the dynamics of S is just a Brownian motion. Yes, that's what I mean. So the arrival of orders so I think that our market maker is only trading with a fraction of the total number of trades. And so in fact, if they're far away from the mid, it's a tiny fraction, like maybe 1% of the volume. And if it's close to 0, close to the mid price, then you're participating in almost every trade. And these dynamics are the trades that the market maker sees, not every trade in the order book. Sure. Yes. So in fact, I think of 0 as the ideal position. But later on, when we go into market making in cryptocurrencies, market makers typically have 2 coins that they need to trade in, and there the target might be 0.5 or half of your budget. So I think that in the first half of the talk, think of the ideal scenario to be flat and have 0 inventory. Yeah, or you can think of maybe this market maker having an optimal position that they want to revert around, and so yeah, there's many twists and generalizations of this. I think for simplicity, let's think of 0 as the ideal position. Mm-hmm, mm-hmm. So these. Oh, okay. Okay. All right. This is very interesting. So technically, when you at the end of the day, xt plus qst may not be quite as safe as xt plus 0 st. Why? Because there's an overnight move that could be gigantic. So in fact, this model will have a certain counterintuitive feature that the trader will be more risk averse at the beginning of the day and will be willing to take on strange inventory positions at the end of the day. So that is definitely something I don't know if you would say was messed up, but you could definitely include xt plus qt plus 1 st plus 1. And there, if you had this extra source of noise for the overnight move, you'd find that the market maker might behave quite different. So yeah, good question. And in fact, in the world of cryptocurrencies, I keep giving you these sneak previews. They never close. So very often people will adapt this model to an infinite horizon or want to make the time t disappear. So rather, they're looking for time insensitive strategies. Why do I assume a Poisson? Well, because a lot of this technology here, the magic that happens between posing an optimal utility problem and then writing an equation that you're able to solve, which is this Hamilton-Jacobi bounding equation, this requires a Markov assumption. And so if you're ever going to have models with jumpiness and you want Markov, then really Poisson is sort of the way to go. Or at least to make these more tractable, because to be honest, these equations are not extremely tractable. So how do we get to this equation if you've never seen anything like this before? Well, what you do is you use the dynamic programming principle, which is that if you want to optimize this between little time t and capital T, you need to do it over the next delta t and then be optimal at t plus delta t onward. And then you take a limit, and these limits give you these partial differential equations. And in fact, when there's Poisson, so the ugliest term, maybe if you've seen the Black-Scholes PDE, this term doesn't scare you much, but these jumpy terms are sort of at the heart of this problem, because what you have is these utilities these differences of utilities, and this is not a very standard PDE. So it ends up well, in this case, it ends up being very hard to solve unless you make some assumptions on the boundedness of the inventory. But I won't get too much into technical details, just to show you that the idea is to set up a problem in a probabilistic sense and then turn it into a deterministic differential equation. And then these are very quite hard to solve numerically. So one way to overcome this is to take asymptotic expansions. And essentially what I'm showing you here is an approximation to the solution of this Hamilton-Jacobi bounding equation. And this solution, you'll recognize a few features or things that I desired about my market making earlier on, but with a few more parameters that we can now discuss. So first of all, there's the idea that the bid and ask prices are given by premiums above and below a reservation price, and that this reservation price is something that takes the mid price and tilts it in the direction opposite to your inventory. And then the extra things to discuss are, okay, what is the beta, or what is this sensitivity of the price with respect to the inventory? And here we see that it's proportional to your risk aversion and to your inventory risk, or rather, and you can see that this depends on time till the end of the day. So in fact, you tilt things more aggressively at the beginning of the day than at the end of the day, something which many market makers would want to see reversed. But and the other interesting thing is that the premiums around the premiums that the market maker has to set around its reservation price has two terms. One that depends on the volatility, and basically the risk of this asset, and the other which only depends on the microstructure. So this K, if you remember, was the rate at which your trading decays as you go further and further from the mid. So think of this as the risk component of the spread, and think of this as the microstructure component of the spread. So and somehow the two are a little bit tied together by this risk aversion parameter. But this is essentially the formulas that in more recent years have seen a little revival. So okay, before I get into this cryptocurrency stuff that I'm sure you're all very excited to hear about, let me Mm-hmm. Yeah. Yeah, but the tilting. Sorry. So yeah, the question is, it's about the behavior of the market maker towards the end of the day. And you're hinting that there are certain aspects that are attractive about this, i.e., the bid-ask spread of the market maker gets tighter towards the end, hence helping them get out of their position. But the tilting up and down around the mid-price behavior in these simulations is that bigger inventories kind of creep up towards the end of the day. So this may not be ideal if you really want a zero position at the end of the day. In fact, many market makers remove that dependency on time and replace t minus t by a constant, and then this would look much more like a tunnel, and most of your inventories would be really tightly controlled throughout the day. Another illustration is that if you plot the P&L, in other words, remember the stock price plus the cash plus the quantity of stocks times the stock price, so essentially your mark-to-market P&L, then you see that this has a positive drift and that it's relatively tight. In other words, there aren't that many losses. So this is a simulation. Don't get too encouraged to start up your market making business tomorrow. But I don't want to discourage you either. So we'll go into the more realistic. In fact, I don't think I want to talk that much about this, other than showing you that this very highly peaked P&L is the strategy that I was showing you earlier, which is controls for risk. And this is compared to another strategy that I call the symmetric strategy, which is we all there's a profit maximizing spread for a risk neutral agent, which is essentially find the distance away from the mid that creates the most P&L per unit of time. And if you do that, you'll see that you'll get the P&L in blue, but you'll find that your inventory will go out of control. So potentially could lead to very big wins, but also very big losses. In other words, this is one of the most important constraints of the market makers is this control of inventory. Yeah.
Control of inventory.
Yeah. This that allow for variable quantities, and that's another way of controlling inventory. And there are also some of these papers that include trends that may last for a small amount of time and alpha signals, and there are definitely some bells and whistles that we can add to that. And in fact, so the shift can there are two reasons you may shift away up and down the mid price. The first reason might be you think or you see maybe in the order book trends through your signal analysis. The other one is you have an inventory that asks you to tilt. So there's the microstructure or let's say price prediction problem, and then there's the inventory management problem. And I think that's so far I've only really talked about the inventory control problem. And now I'm going to show you some results related to live trading. So a few months ago, I had some entrepreneurs from a cryptocurrency market making company that sent me an email and wanted to talk to me. And ultimately, they ended up telling me, "Oh, have you heard of this company called Hummingbot?" And they turned me on to the fact that in this open source software called Hummingbot, there are many market making algorithms that are open source and that people can download and use themselves. And apparently, one of the popular models is this Stoikov model that seems to be sort of a very much used by many crypto companies. The idea being that when crypto coins come into existence, they need to make everyone feel secure that there's a two-sided market for this, and they hire companies to do market making for them, and even give them maybe a portion of the total amount of coins to do this job. And this person was kind of hinting that actually many of them just sort of use the Avellaneda Stoikov model and call it a day. And essentially, this company was interested in sort of making this type of trading available to more people and sort of have a crowdsource of market makers, if you will. So here's a nice picture that I saw. I think it sort of says it all. This is a Bitcoin price chart that I found. And you can see that this is a pretty illiquid market. It goes through very erratic drops. And what you see, the colors here are limit buy orders and limit sell orders that are being updated in the order book. And the color scheme, I think, is just the size of the order. But if you follow some of these little sort of stripes around, you see that it seems like there are some market makers that are hugging the price a little bit like in this Poisson rival model and sort of following it around and waiting to get lucky and essentially hoping to make this bid-ask spread. So I think this is pretty interesting that you can see this on cryptocurrency markets with your naked eye, because in almost any other order book that I've seen that are much denser and where you can't tell one trader apart from the other, you don't really see this kind of behavior of market makers following the price. So it's kind of a nice example. And in fact, I sort of think that maybe the model in our paper was maybe more appropriate for cryptocurrencies than stocks or futures or more liquid assets, specifically because, all right, there's something that I think some people would call it a product market fit. It's this model sort of implicitly assumes that there's a lot of wiggle room for your tilting of your quotes. And in most order books, there isn't. You're either at the top of the book or you're not there. So I think that one of the reasons I've rationalized that people in cryptocurrencies care about this model is because it sort of seems to have been made for it before cryptocurrencies existed. So I find that kind of amusing. So anyways, you can go to this Hummingbot website. It's very simple. There's 12 different ways you can download it. Yep. First asks you is, what's your market making strategy? So here I pick the Avellaneda market making. The second thing it asks you is, what's your data source? And I had to create a KuCoin account for this to work. What's your trading pair? Bitcoin USD. What's the time frame? Infinite. This is the idea that this T minus T is just replaced by a number. Then the amount of Bitcoin per order. So this is the trade size. The risk aversion. And then there's a parameter which is not in the model, but it's an implementation issue. Is how often do you cancel and replace your quotes? So the frequency of updates here, 10 seconds. And then you have to give it your inventory target, so your ideal amount. So your ideal amount in when you trade cryptocurrencies is not zero, and you can't really go short. To my knowledge, you can't really go short in these markets. So really, you put 50 to say that you want to keep your inventory at half Bitcoin, half USD, and then it creates a little configuration file, and it says press start. You can look at this look at the configuration file. Essentially, this is a sort of a very simple heuristic that populates all of the. So I haven't really put any real money behind this, at least not yet. So there's a mid price. It does adjust back to. It spits out a bunch of hypothetical trades that you would have done, and the way it does that is not the first. Okay, and they find where their parameters should be. But the good news is inventory was kept under control, and I think that the more honest answer of why this didn't work is that the mid price does not have a lot of information. So and now I'm going to take you on a little. Let's see how much time I have for this. A little adventure in microstructure, maybe to try to see what can we do. Essentially, answer this question: can we do better than the mid price? Yeah, we have a question. Good question. I think it might be a setting. I didn't really pay attention to that, to the trading. My guess is. So you do. So in many markets, you get rebates for being a market maker. In these exchanges like Binance or KuCoin, they don't really give you rebates. So who will pay you? Actually, the owners of the coin will sometimes pay certain people to keep market making, and that could be a source of revenue. But as a little player jumping in the order book, no one's paying you for that. So my guess is that. But you do pay. Yeah. So unlike the stock markets where you get rebate for limit orders and pay for trading, these cryptocurrency exchanges typically charge both people, and they give you a discount if you trade very high volumes. All right. So let me. Yeah. So I was net long. So during the settings that I chose, here were 50-50. So I was aiming at a 50-50 Bitcoin USD balance. In the stock markets, it's very easy to go short and long, or it's much easier, and therefore the ideal place to be is at zero. In cryptocurrency markets, typically people are between two coins. Yeah, and in fact, this is Bitcoin USDT. If I did Bitcoin Ethereum, maybe this would be even safer, because if I had a 50-50, maybe, I don't know, maybe there would be a bit of diversification. But it's a very risky asset class for sure. So this was the bad news, and let's try to see what's the hope, or if I were to spend a lot of energy on these open source codes, how would I improve them? So let's think a little bit about this. So this gets me into my second topic of the day, which is market microstructure. It's a little bit harder to define. It's a bit of a different people will define it differently. To me, market microstructure is the mechanisms of trading. So being interested in how, and this includes the venues of trading, so the rules of these venues. It also includes the sort of analysis of the participants of trading. Or it's kind of a it's kind of an intersection between the motivations that makes people trade and the places where they end up trading. So it could be now it's dominated by limit order books is the most common mechanism for trading, but there are also dark pools. There are many venues you can trade at, and then there are market makers, but they're just one of many participants. There are some people who trade very differently from market makers. Now, how do people use market making? Well, I may be a bit biased, but I think that one of the big motivations, or not motivation, but the outcomes of market making papers is, by studying this venue and these actors, I can make prediction about the price. And then you might say, that's the ultimate goal of market microstructures. Is it to predict future prices? And I would say maybe why, and again, this is kind of a personal take. I think that all of market microstructure wants to explain away all the mechanics of trading to come to the essence of what the fair price is. And so this fair price sometimes is called the fair price, sometimes it's called the true price, sometimes it's called the efficient price, sometimes it's called the micro price. So these are all different terms that are thrown around for this kind of a holy grail of like, how do I get through all this mess of people jumping around in this venue to the fair price? And so this is kind of the, yeah. Yeah, I suppose. I mean, in the same way that $100 bills on the floor tend to disappear, but I still will pick them up if I see them. But so yeah, so this the barrier to entry is extremely low. So it took me not much time to lose all this money on paper. So I think that and today I'm going to provide you with one idea to improve this. I don't know if this idea will save this strategy. It might take 3 or 4 ideas to make this work, and then whoever gets the 5th idea probably will take most of the money. So yeah, I do agree that this is a very easy. Or there's another risk, which is that this whole cryptocurrency, all these coins are going to collapse, and then that's a genuine risk here. So this is kind of one of my. It gives me the chance to say one of my favorite jokes, which is there are 2 kinds of people: the kind of people who think there are 2 kinds of people, and the others. and so obviously, there's actually a whole spectrum of market microstructures, and there's a lot of variables across which we could look. It's just that I find that large tick size and small tick size almost says it all to me. So about the market microstructure, and I like to focus on this as a defining variable. So large tick size just means that the grid upon which you can put prices is relatively large compared to the price. So think of maybe a grid size, a price of a stock that has a $10 price, and then think of a bid-ask spread of 1 cent, and that's it's 10 basis points. It's a significant amount, and if there are lots of buyers and sellers, that is what I call your quintessential, or what is a quintessential large tick size relative to the price. Now, what happens in specifically in cryptocurrencies is that these markets seem to not have really cared much about the grid size. They just made it super small. And as these prices started going up to 10,000 and 20,000, no one really got the memo that maybe we could change the grid size. So it stayed tiny. And of course, there are many markets where the tick size is small. Other examples are tech stocks that have gone to prices like $2,000, and even though they're very liquid, do not have a single cent bid-ask spread. So those are other examples of small tick size stocks. But I think cryptocurrencies is currently my best example for small tick size. So who has large tick sizes? Typically futures, traded on the CME, for example, very large tick sizes. They're low price stocks just because the bid-ask spread has to be 1 cent. So naturally the tick size becomes large. And then very liquid ETFs or very liquid stocks. And by liquid, I just mean lots of trading happening. And these typically have large tick sizes. And if you look at a chart or a visual of these things, you can see that these horizontal lines show you, it's a visual of the order book. And it basically shows you that the price is almost always at a 1 cent tick. And so in green here, you see the trades. In buy trades, in red, you see the sell trades. And you really see that this thing is very, I guess, chunky, I would call it. It just kind of goes, you can really see when it jumps up and jumps down. And it doesn't look like a Brownian motion, really. And here you can see the Q sizes. And yeah, when I look at a picture like this, I see large tick size. Now, what happened, or the main insights to gather from large tick size assets is that the imbalance is king. So I call this the least well-kept secret in high frequency trading, which is that if you're going to look at a data set that has bid, ask size, ask size, at some point you'll figure out that the ratio of bid size to bid size plus ask size might be something to look at. And it turns out that it matters quite a lot. And it's what I like about this sort of microstructure signal is that it's not one of these signals that you write a paper about it and it disappears. This is here to stay. It's very much part of the structure of large tick order books. So when the imbalance is close to 1, that means there's, let's say, a bid size of 100 and an ask size of 1. That means there's a tremendous amount of buyers and there's only 1 seller at the ask. You've heard about it. So the question, NQA is the quantity at the ask. model on a single factor, well, it's probably this one, especially on large tick stocks. So now, why is that interesting? Well, you can do a few things. You can use the imbalance as a mid price at the moment that the price moves, at this random time to find the fair price. And the idea is to take, okay, the mid is imperfect, around and go up again, or it may bounce back down. So you can see how maybe this, when the spread is one tick, which is unusually small, then you can see that the idea is take a parameter, the parameter that it depends on is just Q. So think of Q as they actually showed that the very just market maker around the mid price, you sort of stay flat. And if you do it around this, so this is, I have to say, kind of in the nature of market making. So it has this, actually in the nature of maybe financial engineering, is that very often things that are built seem like a regular good money maker, like picking pennies in front of a tractor, and it seems like a good business until it isn't. But the problem is that when it isn't, it's sort of the end of your business. So it's a very very exciting business. I like the math behind it. But I'm a little bit afraid to put all my money into it, though my new crypto friends would like me to join them in their enterprises. So yeah, this is all I have for now. If you have any questions, I'm happy to answer.
Yeah, I guess that's it for the day. We are going to be definitely into more videos, but I think Stoikov model seems like a good way to begin market making if you wanna. And like he said, Hummingbird already has an implementation of that. I'm gonna try that in the next video probably. Let's see. Yeah, I'll end the stream for now.